Hello and welcome to the first class of the video series for the United States Personal Income Tax. This particular course is going to be, and video series is going to be based on the 2014 tax year. As we prepare for 2015, there will be an update to the specifics of the individual dollar amounts discussed, but we'll be focusing primarily on the reasons behind the tax code and not getting caught up so much on the actual individual numbers. We'll be looking at how to read the U.S. Publication 17 and how to apply that to individual circumstances. There will be examples, and I hope you all enjoy the video. So the first thing that we're going to do is look at the actual I have slides that go with the course, and we will be reviewing those as soon as I can get them pulled up. Okay, I'm Ginger Garvey. I'm the Senior Partner for Freedom Financial Partners. We are a financial services company that is interested in helping you help yourself, and that's pretty much what we are trying to do. We've got a lot of tips and tricks, and we're happy to share them. In addition, in the Richmond, Virginia area, we provide bookkeeping services and do new business startups. But what we found is that the need is outside of the Richmond area as well. And so we have put together this video series as well as some additional online resources that are available for anyone who's interested. The internet's a big wide world out there. This particular video series is going to be covering the basics in the U.S. personal income tax. The video is designed to teach you how to prepare basic forms and schedules for the individual income tax returns. It's primarily based on the IRS Publication 17 and other relevant IRS documents, and it's based on tax year 2014. The key resources that are available to you would be the IRS website, which can be found at www.irs.gov and www.freedomfinancialpartnersllc.com. This particular video series is going to cover the basics, and then income, and then deductions. There will be an additional video series that will cover more advanced topics, but this one's going to focus in that area. So I'm going to separate the videos by lessons. So this will be Class 1, Lesson 1, and we're just going to be covering the filing information. And I am doing this live, and we do have Andrew Woodard joining us. So Andrew, if you could just say hi. Andrew, say hello.
I'm waiting for the video to catch up.
Oh, no, just say hello now.
Hello.
Okay. And Andrew, if you have any questions as we go along, it's always helpful to me for this to be a somewhat interactive experience.
Okay.
So for Lesson 1, we're going to be focusing on filing information. We're going to cover the history of the income tax. We're going to talk about the Form 1040. The Form 1040 is the primary document that we use to file our income taxes here in the United States. Then we're going to talk about who must file and who should file a tax return. Then there's a few additional filing information. The objective is to become familiar with the 1040, and that's going to really set up this income tax series, video series as well. We want to identify who must and who should file a return and have some basic understandings of general filing information. So filing a tax return, what does this mean? There's a lot of confusion, and people come in and say, I need my refund. I need to file my refund. We don't file refunds, we file returns. And a tax return is the document that's used at the end of the year to reconcile the information regarding your income, the amount of tax that's owed, the amount of tax that's been collected throughout the year, and the amount of either payment owed or refund due, depending on whether you've overpaid throughout the year or whether you've underpaid. In addition, the tax return is now being used for the purposes of the premium tax credit associated with the Affordable Care Act, which allows people to have reduced premiums throughout the year, as well as allowing us to go ahead and receive other types of credits. And some of those credits are refundable credits. There will be a whole class on credits, and today we're really just talking about the very basics. So this is an overview of the 1040 itself, and what I'm going to do is I'm going to cover it in screenshots in sections. So the first section here at the top of the form, you see which tax year that you're working on and the name of the form. So this would be the Form 1040, and you can see that this will be based on tax year 2014. So the next piece is what back in the old days when I was much younger and before tax returns were prepared with software, we were able to receive a packet from the IRS every year, and it actually had a label on it. You would peel off the label. The label didn't include your Social Security number, so you can see that that's set off to the side, and you would just paste the label right on the top of your form. And so this is still called a label, although the IRS does not mail out tax return booklets anymore, and we don't actually have labels. The next section is dealing with the filing status. There are 5 filing statuses on the tax return, and they are single, married filing jointly, married filing separately, head of household, and qualifying widower with dependent child. And we will discuss the filing statuses individually and go into depth in the lesson on filing statuses. The next one is exemptions. Again, that will be a separate section, and we will do a lesson specifically on exemptions. That takes care of the first half of the 1040. The next section is actually focusing on income, and we'll cover a lot of the basic blanks on income in class 2, which will be based on the different types of income. The next section is the adjusted gross income, where we actually go through and make certain adjustments to the income information. And then line 37 is something that is a vocabulary phrase that's used quite often in the tax world, and that's your adjusted gross income. So you can see here that your adjusted gross income is going to be the sum of all of your income and then minus all of the adjustments that you would be entitled to. So your adjusted gross income is different than your total income. Are there any questions on the 1040? And what we just reviewed was actually the front page of the 1040. Andrew, any questions?
No, ma'am.
All right. So, and this is just a highlight again, that your adjusted gross income is your total adjustments minus any exemptions. What will result in your taxable income is your total income minus your adjustments, minus any deductions, and minus your exemptions. So the back page of the 1040, or page 2, since most of us are not looking at an actual form that has a front and a back, the back page of the 1040 is where we get into what will be the taxable income, how the tax is calculated, and then looking at the information about what has been paid in. So at the top of the page, you actually carry over the number from line 37, so your adjusted gross income shows up on that very first line. And then we go through the taxes and the credits, and we look at the itemized deductions versus a standard deduction. We will be covering that in a later class. And we take the exemptions from the front page and total them and put a dollar figure associated with our exemptions on the back page. And then we have the opportunity to enter in refundable credits as well as non-refundable credits. And your non-refundable credits are only there to reduce the taxable amount to zero, whereas refundable credits will result and they look like payments, and you'll see that in your tax refund itself. So here's also a section where you have the opportunity to enter in other taxes. So you see here self-employment tax, for example, unreported Social Security and Medicare that might be required, any additional tax that's being collected based on IRAs. If you have household employees, you can put your taxes here. So this other taxes section allows the use of the individual income tax form to reconcile your tax liabilities with the IRS so that you don't have to file separate forms in addition to your personal income tax return. The next section would be payments and refundable credits. And you can see here where you would enter in the amount that's been withheld on your W-2s, and any 1099 forms. We'll be covering those in the income section, which is in class 2. Then in the refund section, you have the opportunity to put in your routing and account information and have a direct deposit direct from the IRS if you are due a refund. And then in addition, if you owe taxes, there's a place where you can indicate the amount that's due. There's an opportunity to put in a third-party designee if you do not prepare your taxes yourself and you want someone else to be able to talk to the IRS on your behalf and handle any additional requests for information or anything that requires clarification. You can put a third-party designee right here in this section. And then there's a place for you to sign the tax return yourself. And if you have a preparer sign it, if you have a preparer sign it, there's a spot for them to sign as well. Any questions on the back page?
No, ma'am.
All right. Now we're going to get right into who must file and who should file. You must file a tax return if you are a U.S. citizen or a U.S. resident or a resident of Puerto Rico, and you meet the filing requirements that apply to you. So we will be talking about which filing requirements those could be. Your filing requirements are based on your gross income, your filing status, and your age. So the filing requirements would depend on those 3 factors: your gross income, your filing status, and your age. Income that would be subject to income tax would include the following: any wages, salaries, bonuses, and commissions. Certain types of fringe benefits are actually taxed: tips, unemployment compensation, interest and dividends, and refund and state and local taxes may be taxable. In addition, alimony, income from self-employment, hobby income, any gains from the sale of property, pensions and annuities, or IRA distributions would also be subject to income tax. In addition, we have the taxable portion of Social Security and railroad retirement benefits, any jury duty pay, gambling winnings. That's something a lot of people don't realize. You understand that if you win the lottery, you'll be paying taxes on it. But if you go just to casinos, any gambling winnings is subject to income tax as well. Some scholarships and fellowships are actually considered income. In addition, debt cancellation. So if you had the opportunity to have debt reduced either through a mortgage write-off or through credit cards being where you negotiated a lesser amount to be owed, and there's been a lot of debt consolidation over the last few years, any debt that's canceled is actually considered income. So if they wrote off $3,000 off your credit card balance for you, that's actually considered income on your tax return. And many court awards would also be considered income. So the income requirements are based on your filing status the income tax return, whether you have to file or not, is based on your filing status and your age. So we are going to assume that you know your filing status for the purpose of this particular lesson. We're going to get into how you determine your filing status in the next lesson. So for now, we'll just assume that you know what your filing status is, and we'll go forward from there. So if your filing status is single and you're under the age 65, then you would have to file if your income was at least $10,150. So this is how this is determined. This table 1.1 is from the IRS publication 17, and you can read here the age amounts and the filing status, and you would just look it up on the chart. So for example, if you're married filing separately, it does not matter how old you are. If you make at least $3,950, you're going to need to file. Now, these figures are not randomly generated. The figures are actually a combination of the standard tax deduction and the exemption amount. So the exemption amount in 2014 was $3,950. So if you made over $3,950 and you were married filing separately, you would need to file. So you'll see this $3,950 a few more times throughout this particular lesson, and I just want you to understand that the correlation of what that number means is that that's actually the exemption amount for a person in 2014. Then we'll move on. So for example, we have Bill here, and he's not married at the end of 2014, and he lived alone. So his marital status is single and his filing status is single. On December 31st, he was 35 years old. So he would choose under 65. In 2014, he had a part-time job as a carpenter for which he received wages of $9,800. In addition, he made $400 from his snow plowing business. This is saying Tom does not have to file a return, true or false? False, because his income is $9,800 and his self-employment income was $500 or $400. It would give him the total of $10,300. And because it was at least $10,150, Bill would have to file a return. Frank and Linda are married and living together at the end of 2014. Frank turned 65 and Linda was 69. They're both retired. Frank received a pension of $17,000 and they received $4,500 in interest and dividends. Their marital status is married, living with a spouse, and their filing status is a joint return. They have no other income and they did not have to file a return, true or false. In this case, it's true. Because Frank turned 65 on January 1st, he's considered to be 65 at the end of 2014. So both spouses are 65 or older. Their gross income would be $21,500, the $17,000 in pension plus the dividends of $4,500. They do not have to file a return because their gross income is less than $22,700. In this instance, Peter is married and he's not lived with his wife for 2 years. They have a child, Peter, and their child lives with him. They have a child and the child lives with Peter. Peter is 40 and his gross income was $11,500. His marital status is married, but he has a child and he's living apart from his spouse. So his filing status may be head of household. In this instance, we're saying Peter does not have to file a return. And this is true. His gross income limit for his age and filing status would be $13,050. So he would not have to file a return. If Peter had used married filing separately as his filing status, then he would have to file a return because his income would be more than $3,950. The filing requirements for dependents is what we're going to be talking about here. These are based on the gross income, the earned income and unearned income, marital status, age, and blindness. You'll see the phrase blindness in several places in the IRS code. One of the things that I say when I'm teaching classes live is I kind of joke around and say, you know, well, if you're old and blind, the rules are different. But that is actually the truth. If you are over certain ages and you are considered blind, there are different tax laws that apply to you. So the filing requirements for dependents look pretty complicated. So we're going to just go ahead and deconstruct these into something that makes a little bit more sense. The first thing that you have to do is determine whether the dependent is married or not. So if the dependent is a single dependent, then you must file a return. It says if any of the following apply. If your unearned income was more than $2,550. So if your unearned income was more than $2,550, or your earned income was more than $7,750. If the combined income is more than the larger of $2,550, or your earned income plus $1,900. So what they're really trying to do here is identify unearned income with people who are being claimed as a dependent, because your parents are definitely able to make investments in the names of the children, but if the children have unearned income that is over $2,550, it requires a tax return to be filed. This does not necessarily mean that there will be taxes owed. It is simply means that there is a requirement to file the tax return. If your earned income is more than $7,750, you would be required to file a tax return as well. If you are a married dependent and you are not over age 65 or blind, if your unearned income is more than $1,000, you would need to file a tax return. If your earned income is more than $6,200, you would need to file a return. And then your gross income was at least $5 and your spouse files a separate return and itemizes deductions. In that case, you would also need to file a tax return. The reason for this would be the $6,200 is the standard tax deduction, which would take your earnings down to zero. However, if your spouse files and itemizes their tax return and claims a itemized deduction of greater than $6,200, then you have to file if your earned income was at least $5, because you do not have any standard deduction. And that'll be explained in more detail in the standard deduction and itemized deduction lesson. So here we have Gloria, and she's 16 years old and she's single, and she can be claimed as a dependent by her parents. In 2014, Loretta received $1,200 in interest from her bank account. This was her only income. I think that we just have a name error here. So we have Gloria was 16 and Gloria received $1,200 in income from a bank account, and this is her only income. So would she need to file, yes or no? So we would look at the chart, and the answer would be yes, she does need to file because she received $1,200 in interest from her bank account. So let's go to the chart itself. She is a single dependent, and she is not underage. She's not over age 65. Her unearned income is more than $1,000. So you can see here on the, this is what we're talking about here. So she's under age 65. She's not blind. She would have to file a return if her unearned income is more than $1,000. And so since she received an interest of $1,200, this would have her filing the return. Gloria has a sister, Leslie, and Leslie is 15 years old and single and can be claimed as dependent by her parents. She earned $2,500 from her job at the supermarket. In addition, she received $225 in interest from a bank account. Will she need to file a tax return? And the answer is no, because Leslie's earned income is not more than the $1,000. Her unearned income is less than the $1,000, and her earned income is less than the $6,200. So she would not have to file a return. Are there any questions about the examples that we've gone through so far?
Yes, the married dependent, that doesn't refer to a spouse, does it?
You can be a married dependent if you are claimed by your parents and your spouse does not claim you. You cannot be claimed on 2 tax returns. So in that case, what they're talking about, you're married and you're being claimed by somebody else. You would not be being claimed by your spouse, no.
Okay.
Other situations when you must file a tax return. You must file a tax return if any of the 4 conditions below apply. You owe any special taxes, including the alternative minimum tax, any additional tax on qualified plans, if you are owing household employment taxes, if you owe any Social Security and Medicare taxes, if you received a first-time homebuyer credit and now you are trying to pay that back, that requires that you file. Any write-in taxes, which would include any uncollected Social Security and Medicare that would be on tips that you might have received, and to recapture any taxes that are owed. Or if you received a HSA, Archer MSA, or a Medicare Advantage MSA distributions, these are medical savings account. HSA stands for Healthcare Savings Account, and the MSA is just medical savings accounts. If you had net earnings from self-employment of at least $400, this is a big one. So what they're saying is if you had net earnings from self-employment of at least $400. So if you had a hobby that you were choosing to sell things that you make, let's say that you're making Christmas tree ornaments and you sell them at a local craft fair and you make $600. If the parts for the Christmas tree ornaments were more than $200, then your net earnings would be less than the $400 and you would not need to file. So you would need to keep track of the expenses associated with that $600 in earnings to determine whether or not you meet the threshold to have to file a tax return based on self-employment. Then here we have if you had wages of $108.28 or more from a church or a qualified church-controlled organization that is exempt from employer Social Security and Medicare taxes. In that instance, you would need to pay the Medicare and Social Security tax portion as well. Any advance payments of the premium tax credits, if they were made for you or your spouse or a dependent who enrolled in coverage through the health insurance marketplace, you would receive a Form 1095-A, and it would show the amount that you needed to pay, and you would be required then to file a tax return. So anyone, regardless of your income, that is securing health insurance through the health insurance marketplace will be required to file a tax return. It does not mean that you will owe taxes. It does not mean that you're necessarily getting a tax refund. You are required to file a federal tax return to demonstrate how things played out with your premium tax credit is what it really is. So you report your earnings, you look at how much of a premium tax credit you were entitled to. If you were entitled to more than you received, you'd receive it. If you were entitled to less than you received, you would need to pay that premium tax credit back. So here we're going to talk about Mary. Mary was not married and she was 67 in 2014. She received a taxable pension benefits in the amount of $9,100 and $900 in interest and dividends. She makes extra money cleaning houses. In 2014, her net income from cleaning houses was $750. Would she have to file a return? She does have to file a tax return, true or false? And so we're going to say true. Even though her gross income of $10,800 is below the $11,700, which would be her filing requirement, she still must file a return because her net self-employment is at least $400. So based on her self-employment, she would actually have to file. Situations when you should file a return. Even if you don't have to file a tax return, you should file a return to get back money if you had income tax withheld, or if you qualify for earned income credit, if you qualify for the additional child tax credit, or if you qualify for any other refundable credits, then you should go ahead and file your tax return and get that money back. Here's just some additional information. We reviewed the 1040 in detail. There's two other 1040 forms that are possible to be filed. One is a 1040EZ and one is a 1040A. And we're going to go over just very briefly what the filing requirements are for those. So with a 1040EZ, you have to be either single or married filing a joint return. There cannot be any additional personal exemptions other than yourself and your spouse. So in other words, no dependents. For the 1040EZ, no dependents, and it only works with taxable income that is less than $100,000. Your income can only be from wages, salaries, tips, scholarships, fellowships, grants, interest. Your interest has to be less than $1,500. And unemployment compensation, or the Alaska Permanent Fund dividends. I always like this part because the Alaska Permanent Fund dividends is actually like a reverse tax for people who live in Alaska. If you're a citizen of Alaska, you actually receive a payment for living there. So one of the few states that they pay you to live there. The 1040A, you can file the 1040A if you are single, if you're married filing a joint return, if you're married filing a separate return, if you're head of household, or you're qualifying widower. So you can actually file with all 5 filing statuses. You are allowed to claim any exemptions that you are entitled to, including your dependents. It's only valid for taxable income less than $100,000. And there are certain schedules that are not included in the 1040A. So if you have any income that is included outside of the list that's described here, which is pretty exhaustive, then you would not be able to use the 1040A. Are there any questions?
No, ma'am.
Okay. In order to file a United States personal income tax return, you need to have a tax number. Social Security numbers are used by people that are eligible to work, U.S. citizens, resident aliens, anyone who is granted permission to work can receive a Social Security number. Children born in the United States can receive Social Security numbers. In the event that you were born outside of the United States or that you are not eligible for a Social Security number, you have 2 options. There is a ITIN, which is an individual tax identification number. This can be applied for using a W-7. And that would allow you to be on a income tax return. Whether you are the filer or a dependent, you can use an ITIN to allow you to claim the exemptions or file your taxes. So that's what the ITIN is for. And in order to request an ITIN, you file a W-7. The other option would be an adoption tax identification number. The adoption tax identification number is used primarily when there's an adoption that is taking place and the person to be adopted is not a U.S. citizen and is not yet eligible for a Social Security number. So once the adoption is final, then they would be considered a U.S. citizen and they would be entitled to a Social Security number. So in the interim, you would use an adoption tax identification number. There are a few other things that are on the 1040. One of them is a presidential election campaign fund. It was determined years ago that we as taxpayers, or actually tax filers, some of us aren't even taxpayers, have the option of designating $3 to go to the presidential election campaign fund. That $3 does not have anything to do with the amount that you pay or the amount that you receive back. It is actually a way of designating $3 of the IRS's portion of the money to be used for the presidential election campaign fund. Due dates. We believe that the due date is traditionally April 15th, and April 15th is based on your tax year being from January 1st to December 31st of a calendar year. In the event that you elect to have your personal taxable calendar year be different than January through December, you are able to do that, and that would adjust your due date for your tax return as well. There are two accounting methods that are used. The cash method is pretty much used by all of us. And what the cash method means is that when you receive the money, or the money is able to be available to you, constructively receive is what we use, the word constructively receive the money, then that is considered income and it's credited into your account so that it would be taxable. With the cash method, you would deduct any expenses in the year that you pay them, so that you include income in the year that it becomes available to you, and you include expenses in the year that you pay them. In the accrual method, you would actually report income in the year that it is earned. It may not actually be paid to you in that year. And you would deduct expenses in the year that they are incurred, and it may not actually be the year that they are paid. So accrual method you usually see with people who are working in multi-year contract situations where they may have a $3 million contract, but it is expected to be paid out in an allocated amount of $50,000 per year on average, but in fact you don't finish your milestones in year one, so you don't get the money in year one. Under accrual, you would still report the earnings in year one, even if in year two you got paid for both the $50,000 for year one and the $50,000 for year two. So instead of the cash method would show the $100,000 in year two, the accrual method would show the $50,000 in each year. So we've got a couple of accounting method problems. Brad completes a carpentry job in November and is paid in 2014. Must he report that income in 2014? Yes or no? Jill received a valid paycheck on December 31st. Is this still part of her 2014 gross income, even if she doesn't cash the check until 2015? And the answers to both of those are yes. Because Jill's money was constructively received by her in 2014, even if she chooses not to cash the check until 2015, it is still taxable in 2014. Here we have Anne receives a method from a bill from the hospital in December 2014, but she doesn't pay the bill until January. So therefore, she cannot include this bill in figuring out whether to itemize deductions in 2014, true or false. Brad, the carpenter that we talked about in number 1, used the accrual method. So he would report the income from a job completed in November on his 2014 tax return, regardless of whether he was paid in November or January. And both of those are actually true. Another thing that's just kind of a little factoid, so we threw it in here, is that the IRS does not want your pennies. So keep your pennies to yourself. If you have a dollar amount that is 49 cents or smaller, it would be rounded down. If you have a dollar amount that is 50 cents or greater, it would be rounded up. So we actually round everything when we go to put them on the tax return. You don't want to round multiple times. You want to go ahead and complete all of the math before you hit the field that you're going to be entering the number into. Once you go to enter the number into that field, at that point you would take the rounding. So we have a few more topics. We're going to talk about refunds, where to file, and in the event that someone has passed. So refunds are a return of money that has been paid in to you, or they can result from refundable credits. Where to file? The IRS prefers electronic filing. That's available free on the IRS website. If you have certain income levels and you have pretty basic tax returns, you can use their iFile system. And in the event that someone has passed away during the calendar year, it is necessary to file a tax return on their behalf. So regardless of what day they passed away, there would be one last tax return within that calendar year to reconcile and to report that death through the income tax process. Any questions on that, Andrew? Okay. So in this little mini class that we've gone through, what we've done is we've talked about the requirement to file a tax return is actually determined based on your age, your filing status, and your income. You can be claimed by a dependent on another person's return. You may still have to file a tax return, even if you don't meet the gross income requirements for your age and filing status. There's a separate table you would need to look at for dependents. And there are other conditions that might require you to file, such as having more than $400 in net earnings from any type of self-employment. So we're going to go through some classes, some true-false questions together, and this is going to hopefully support and get those facts right in your little heads. So classwork, true or false? You do not need to enter a social security number or individual tax identification number on your tax return. Andrew, I'm going to let you answer.
False.
That would be false. You do not have to file a tax return if you did not earn wages. That's going to be false too, because it depends on where you are with those premium tax credits and the Affordable Care Act. You'll have a lot of people that are going to be required to file tax returns that would not normally have to. If you are self-employed and you have no other income, you have to file a return if your income is $400 or more.
True.
True. Generally, dependent children who meet the filing requirement have to file a tax return.
True.
If they meet it, yeah. A single person, I usually just go through this page. A single person who has wages of $2,000 and a federal withholdings of $120 should file a tax return even if he or she is not required.
True.
Whether you are required to file a tax return depends only on the amount of income you receive.
False.
A dependent whose only income is interest from a savings account may be required to file a tax return.
True.
If you are not a dependent and your gross income is less than the filing requirement for your age and filing status, you may still be required to file a return.
True.
You can file a 1040-EZ if you are married filing separately.
False.
Right, only if you're single or married filing jointly with no dependents. Interest from a savings account is an example of earned income.
False.
Right, that's unearned income. On the 1040, taxable income is the same as your AGI.
False.
Right, your taxable income would be your AGI and add any additional taxes, subtract any credits, and your exemptions and your deductions, and that will give you your taxable income. The total of all income minus any adjustments is called your adjusted gross income.
True.
That is true. Okay, we're going to look at the following taxpayers, and we're going to say this is not for dependents. So what would be the gross income level at which they would have to file a return? If you're married and you're filing a joint return and you're both age 65.
22,700.
If you're married and filing a joint return and you're both age 63.
20,300.
If you are a qualifying widower with dependent child and you are 64.
16,350.
If you are single and 23.
10,150.
If you are married and you're filing a separate return and you're 65.
3,950.
If you're married and you're filing a joint return, one spouse is 67 and one spouse is 58.
22,150.
21,500.
21.
Because one is above and one is below. If you are head of household and you are 29.
13,050.
Very good. If you are single and you are 87.
11,700.
11,700. So that concludes the classwork. Andrew, any questions?
No, ma'am. I think I've got it.
Okay. Well, we will be back with lesson 2 shortly. Thank you so much for your help today.
No problem.